Hello. Many of you may be using mutual funds for your financial planning or wealth creation. But are you aware of all the ways you can truly use this vehicle to meet most of your financial needs? In today's episode of One Step Ahead show by DSP Mutual Fund, I'm going to take you through an interesting investment option that can help you navigate market volatility. And I'm joined by Devang Chavda. Devang is a part of our product management group at DSP Asset Managers, and he has more than a decade of experience in the financial services industry. He has joined DSP way back in July 2019 as a product strategist and has been instrumental in launching a host of new funds and market-related reports. Prior to joining DSP Asset Managers, Devang has also worked with Angel Broking, Axis Bank, and Deloitte. Devang is a chartered accountant and an All India rank holder. He has also done his CFA and CIPM from the CFA Institute, US. Welcome to the show, Devang.
And thanks, Sumana.
So before we start the conversation with Devang, request all our viewers to share any question that you have in their mind in the comment section, and we shall get back to you at the earliest. To all the audience, if you enjoy our content, please like the video, subscribe to our channel, and press the bell icon to get the latest video updates from DSP Mutual Fund. So Devang, we would want to know for our audience, what exactly is an STP or systematic transfer plan in mutual funds, and how can it help our investors manage their investments?
So, Sumana, as the name suggests, STP refers to systematic transfer plan. It's a mechanism wherein an investor can park money into a debt fund and can systematically transfer that money from debt fund to equity fund over a defined tenure. So let's take an example level to understand it better. Let's say there is a person known as Mr. X, and Mr. X has received 1 lakh rupees bonus from his organization during his appraisal. Now Mr. X wants to invest this amount into equities, but he is unsure about the timing, whether is it the right time to invest or not. So in such case, Mr. X can take help of this mechanism, which is STP. So what will Mr. X do in this case? Mr. X will first invest this 1 lakh rupees bonus into a debt fund, let's say liquid fund. He will then start a monthly STP from liquid fund to equity fund, let's say for a 10-month period. What essentially will happen is that every month 10,000 rupees will get transferred from debt fund to equity fund, and Mr. X will eventually accumulate units in equity fund. This using STP, Mr. X, if you see, is hedging the risk of investing at market highs here, and he is averaging his cost of holding. This is what STP means, a layman term.
All right. We have also come across this concept of super STP. How is super STP different from this usual STP that you just defined? And how do you think that can help our investors?
Yeah, I will like to answer the second part of question first now, Amanda. What are the biggest fear an investor has? First one is FOMO, which is nothing but fear of missing out. So this happens when markets are going up and investor remains uninvested in the market. He feels that "Kya I am losing out on the returns in the market." The second important fear which a typical investor has is fear of loss. Basically, when I have invested money in equities and if equity goes down, I will incur a loss. That is again one of the important fear an investor has. So super STP as a concept tries to address both these fears. In an usual STP, fixed amount get transferred from debt to equity, as I mentioned in the previous example, and this amount is predetermined by the investor. But in case of a super STP, the amount which get transferred from debt fund to equity fund varies in every installment, and it is determined by market valuations. If the market valuations are high, lower amount will be transferred from debt to equity. Similarly, if market valuation is low, a higher amount will be transferred from debt to equity. So this is how super STP works.
Devang, thanks so much for highlighting two very important behavior biases that many of our investors have also mentioned. And in many of the financial wellness sessions that I conduct, these are very common questions that our investors have highlighted for us. But Devang, you also mentioned about the usage of market valuations in case of STPs. How is it typically used in a super STP?
So in super STP, the amount of money which gets transferred from debt to equity is determined by a valuation score. The valuation score is a score which is again derived using proprietary model by giving equal weightage to three important market valuation parameters. The first one is price to earning, second one is price to book, and third one is bond yield and earnings yield. Using all these three parameters, a score is determined, and the score ranges from 0 to 100. Wherein, if the score is 0, it means that markets are very cheap in nature, while the score of 100 represents that markets are very expensive relative to its history. So this is how the valuation score is being used.
All right. So you have highlighted three important parameters: price to earnings, price to book value, and bond yield versus earnings yield. Would you explain in short and elaborate the importance of each of these parameters? And also, how can these be helpful for our investors?
Sure. So let's understand each of these concepts one by one and understand what is the importance of this parameter. Let's start with price to earning ratio. Price to earning ratio represents how much money you are willing to pay for 1 rupees of profit. It is arrived by dividing market price with earning per share. Now this ratio is very important because it focuses on the fundamental part of any business, which is profitability. If let's say I want to buy any business, the first and the most important thing which an investor will look at is basically how much profit that company or that businesses make. That is something which is captured by price to earning ratio. The second ratio is price to book ratio. Price to book ratio represents that how much money are you willing to pay for rupees 1 of book value. That is net asset of the company. It is arrived by simply dividing market price by book value per share. Now, why this ratio is also important? Because it helps you to know that the price which you are paying for that business, whether the business has sufficient asset to justify that price. This is also again an important part in terms of market valuation. Third and important part is the differential between bond yield and earnings yield. Bond yield refers to the yield which you get from a bond. So just to simply put, let's say you are getting 7% returns from fixed deposit. So your yield from fixed deposit becomes 7%. Earnings yield represent the return which you are getting from equity. So for example, if you are putting 100 rupees in equity and you are getting 5 rupees as profit from that investment, your earnings yield is 5%. So when the earnings yield is more than bond yield, meaning that let's say your bond is earning 7% while your equity investment is giving you let's say 10%, it means that equities are providing you better returns, and that way equities will be more attractive as compared to bonds, and the same goes with vice versa. So this is also an important factor which we consider and is given a weightage in the super STP functionality.
Right. Thanks, Devang, for simplifying all these parameters that actually help us to determine the equity valuations. Coming to the valuation scores again, how is that used to determine how much of money would be transferred in the super STP method?
Right. In super STP, investor needs to input two important parameters. One is base installment amount, second is target amount. Target amount is the total amount which investor wants to be transferred from let's say debt to equity. Base installment amount is the installment amount that needs to be transferred periodically. Both of these values needs to be inputted by the investor. Now, based on the valuation score, a multiplier is determined and it is applied to the base installment amount which was inputted by the investor. If you see the actual installment amount which will get transferred from debt to equity will be a function of base installment amount as well as multiplier. During high valuation score, a lower multiplier will be used and accordingly lower amount will be transferred. Similarly, during low valuation score, higher multiplier will be used and accordingly a higher amount will be transferred. Just to show you in terms of data, if you can see this chart, so this is basically this chart gives you valuation score as well as the amount transferred in a graphical format. The left hand side represents the valuation score, or the black line represents the valuation score, and the blue bar represents the amount which is transferred. So if you see in period like 2008 2009, wherein the valuation score was very low, it was like somewhere around 10, which means that markets were very cheap. During that time, a very high amount was being transferred. Similarly, during COVID, if you see, the very a higher amount was transferred to equity. In case of a high valuation score zone, if you see, it was precisely in 2021, wherein the valuation score was very high, lower amount was transferred from debt to equity. This is how valuation score and the transfer amount is correlated.
Thank you, Devang. So, Devang, what is the frequency of transfer that is allowed for a super STP? And also, what is the maximum and the minimum amount that can be transferred in that chosen frequency?
Currently, for Super STP, weekly, monthly, and quarterly frequency is allowed. Now, minimum and maximum amount that will be transferred will be dependent upon base installment amount and the multiplier, as we have seen in the earlier example. So, multiplier ranges between 0.1x to 10x in case of Super STP. This means that, let's say, base installment amount is 10,000 rupees. The minimum installment amount which will be transferred will be 1,000, and the maximum installment amount that will be transferred will be 1 lakh. This is for a base installment amount of 10,000. If the base installment amount is higher, then accordingly the numbers will vary. Now, what base installment amount an investor needs to choose? So, based on the historical data, what we have observed or what we recommend to the investor is that in case of a monthly transfer, the base installment amount should be target amount divided by 12, which is representing the 12 months. For a quarterly transfer frequency, the base installment amount should be target amount divided by 4, because in a year there are 4 quarters. For a weekly transfer frequency, base installment amount should be target amount divided by 50. 50 again represents 50 weeks in a year. Just to give an example, if the target amount chosen by the investor is 6 lakh rupees for a monthly super STP, then the base amount should be 6 lakh divided by 12, which comes to around 50,000. This is how an investor needs to derive at base installment amount.
Right. That was a few numbers that you have mentioned. Can you show us an illustration of how this entire concept of super STP works? I think that would be quite helpful for our investors.
Sure, Sumana. If you can see this illustration, what we have done is that we have considered a super STP, let's say, of a target amount of rupees 1.2 lakh rupees. So, and there is an investor who wants to invest 1.2 lakh via super STP. And we have taken period from January 2008 to December 2008. As target amount was 1.2 lakh rupees, the base installment amount which was determined was 10,000 rupees, meaning that 10,000 rupees will be transferred every month in case the valuation score remains at a moderate level. If you see this data, and we have taken here Nifty 500 multi-cap index as a proxy to an equity fund. If you see this table, in January 2008, your Nifty 500 multi-cap index value was 3313, but based on the valuation of the market, the valuation score came to around 94. Again, 94 represents, if you recollect, 94 represents the higher valuation band. Accordingly, the multiplier was only 0.1. Now, if you see the actual installment amount was 0.1 into 10,000, which is 1,000 rupees. For the month of January, 1,000 rupees was transferred from debt to equity here. And accordingly, units were created and 1,19,000 was remaining to be transferred. Same way we go for Feb, March, we derive at valuation score, we derive at multiplier, and accordingly actual installment amount is derived and units are created. Now, if you recollect, 2008 was the year of financial crisis, and in the November 2008 market bottomed out, October to November in between. So during this time, if you see, the valuation score was 15, which is like very low. And since valuation score was very low, it was a very favorable time to invest in the market. Accordingly, if you see, the multiplier applied was 8. And 8 represents that the actual transfer amount should be 10,000 into 8, which has to be 80,000. But since we had already transferred some amount earlier, the remaining balance was around only 77,500. So what Super STP will do, it will transfer entire 77,500 in the month of November. So essentially, if you see Super STP, when the valuations were high, it had transferred very low amount. But as the valuation became very cheap, it has transferred a very significant chunk in the market here. Accordingly, over a 5-year period, if you see the performance of Super STP, the 1,20,000 which has been invested by an investor had become 2.7 lakh, giving a 5-year return of 17.8%. Now, so what does the 17.8% represent? How do you interpret this number? So for this, what we have done, we have plotted down a normal STP as well as we have plotted down a lump sum amount. So in case of if the same investor would have started a normal STP, the units accumulated would have been 60.2 as compared to 81, and accordingly the portfolio value would have been 2 lakh. Wherein the return, if I calculate CAGR, the return would be 10.8% as compared to 10.8%. Super STP gave 17.8% return. When we compare this with lump sum, wherein an investor invested entire 1.2 lakh on the 1st Jan 2008 itself, the amount after 5 years was 1.2 lakh only. It means that investor has actually earned 0% return in case of a lump sum investment. This is an important example where Super STP will work beautifully. Basically, investing at market highs. If an investor, let's say, starts Super STP today and let's say fall in the subsequent years and valuation becomes lower, Super STP as a concept will make a lot of sense as compared to lump sum investment.
So, Devang, thank you for explaining how a Super STP works and how it has outperformed normal STP and lump sum over a period of time. But what you mentioned is a typical scenario of a financial crisis period. How about the performance of Super STP over normal STP and lump sum in other situations?
That's a good question. That is something even we also want investor to look at. Don't just look at one particular time frame, rather to look it on a rolling time frame. So Sumana, to answer your question, what we have done is that we have done an analysis of a 5-year rolling performance of Super STP versus lump sum as well as Super STP versus a normal STP. If you see in this first graph, on a rolling 5-year basis, Super STP has most of the time it has outperformed. Around 67% of the time it has outperformed lump sum investment. There are 33% of the time it has underperformed, and average outperformance is around 2.3%. When we see the same graph comparing Super STP with the normal STP, the outperformance is more better. So the average outperformance is 2.8%, while 80% of the time Super STP has outperformed normal STP. Now, to give you more data on this outperformance on in terms of returns, if we see a 5-year rolling return basis, average 5-year rolling return for a Super STP mechanism is 15.3% as compared to 13.1 for lump sum and 12.6 for normal STP. The most and important thing to highlight here is the percentage of time returns were greater than 10% or greater than 12%. The percentage of time it was greater than 10% is very high as compared to a lump sum and a normal STP. This data point represents that Super STP as a concept can increase your probability to earn higher returns from equity over a longer period of time. So this is a very, very important use case for Super STP.
So, certainly, performance is a very important indicator that, on an average, the investor looks at to evaluate any concept or any particular fund. And you just showed that Super STP has outperformed lump sum investments 67% of the time. But what are those situations when Super STP can underperform? And what should an investor do then?
Correct, correct. Very important to know the risk side also of any product or for any mechanism. So even Super STP, there will be time when it may not work. So there are, when we have observed the data, there are two particular time when Super STP hasn't worked well. The first one, if you can see the screen, the first one is basically when the markets are rising while valuations remain elevated, and Super STP had suggested a very low investment from debt to equity. During such time, the Super STP as a concept may not work. Accordingly, if you see from 2005 to 2007, if you see, this was a time when equity market had a very strong as well as very prolonged bull run, and valuations were getting stretched and stretched. During this time, if you see, the amount which was transferred from debt to equity was very less, and accordingly units collected were very low, and Super STP had underperformed the lump sum investment as well as the normal STP. So during such time, lump sum investment will make a lot of sense. The second case when Super STP may not work is when investments are made at a lower valuation level. Example of, let's say, 2009, when market valuations were very low. So during this time, if somebody would have done a lump sum investment, they would have got a decent return as compared to doing Super STP. Because since markets are at very low valuation level, it will make a lot of sense to do a lump sum investment rather than doing a Super STP.
Right. A very common mistake that most investors do when they start investing in a certain concept or a certain fund is, often when they see underperformance for a while, they tend to withdraw their funds from that particular investment. When it comes to Super STP, what is the ideal time frame that an investor should have in mind, that they can expect that they will see good performance after that particular time frame?
Right. Average time taken for like based on the past historical data, average time taken for Super STP to deploy money from debt to equity is around 18 months, and the highest time taken was around 41 months. Now, to have a good investing experience for an investor, ideal time frame which we recommend for investors is at least 5 years for Super STP.
Right. Devang, now that we know the usefulness of Super STPs, can you summarize for our investors how can Super STP be helpful for them to manage their wealth and their investments better?
Sure. So Super STP is a mechanism which tries to improve investor investing experience. It addresses the biggest fear an investor has, which is basically investing at market highs. So Super STP tries to solve that fear as the investments are staggered and are staggered based on a fundamental factor rather than taking any random number. Second important use case is that he removes the need for an investor to time the market. So whenever an investor wants to invest a lump sum amount and he's unsure about the timing, Super STP can be something which an investor can opt for. So third and important part about Super STP is that based on the past data, what we have observed is that Super STP has more often provided returns of more than 10% over a 5-year period than lump sum and normal STP. So somebody who expects a consistency of performance, Super STP can be one of the go-to mechanism. However, as I had explained, that there are two important times when Super STP may not work. First is basically when markets are rising continuously and valuations are getting stretched, where Super STP will not work. Second thing, when market valuations are very low, in that case, a lump sum investment will make more sense as compared to Super STP. So these are scenarios when Super STP will not work well.
Right. Devang, thanks so much for joining us today and taking us through this interesting concept of Super STP. To all our viewers, I'm sure by now you have already put down your questions in the comment section. But if you need more help managing your money, please click the link in the YouTube stream and we will contact you ASAP. And yes, don't forget to leave your feedback about this conversation. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.